We know that successful trading is about selling something at a higher price than the amount that you have bought it for.
In a different perspective, it is all about acquiring something that is worth the amount that you have paid it for. And to be able to do this, one must learn about the product that he is selling or buying, where to buy or sell it, and who to buy or sell them to.
So, as a financial investors and traders, it is important that we know and understand the product even before trying to trade it, which in our case are financial instruments. Hi, I'm Rihanna Joy Cruz.
And I am Jan Kenneth Clemente, and we welcome you to today's episode of 5-Minute Course.
An introduction to financial instrument. Let's start by defining what financial instrument is. Financial instruments are legal agreements that requires one party to pay money or something else of value, or to promise to pay under stipulated conditions to a counterparty in exchange for the payment of interest, for the acquisition of rights, for premiums, or for indemnification against risk.
In short, financial instruments are monetary agreements that can be created, sold, modified, and settled. Defining it would include three main layers. First is that financial instruments are all contracts. The second layer is whether it is a cash or derivative instrument. And the third layer is that financial instruments can be split into four asset types, namely equities, foreign exchange, commodities, and debts. All of this we'll discuss in detail as we go further in this lesson.
Let's first define what contract is. Contracts simply are legally binding agreements to buy or sell between two parties participating in the financial market. Next up is that financial instruments can be also identified whether it is a cash or a derivative instrument.
The price of cash instrument is determined directly by a market. Example of these are deposits and loans, because in here, lenders and borrowers directly agree upon what will the amount of transactions be. In contrary, derivative instruments are simply derivatives as its price determined by the performance of an underlying asset or variable. Its prime example are futures and options because the amount of income from these transactions can vary depending the changes in price of shares of a particular company.
The third layer says that financial instruments can be classified into one of these four asset classes. Starting off with equities, which means a portion of company's asset that the shareholders own as opposed to what they have borrowed. Of course, it is the duty of the company to generate profit for its shareholders, which pays in form of dividends. By definition, a dividend is a financial reward for taking the risk of owning a share only if the price of the shares increase. In case that its price decreases, it is a loss for the shareholders, hence the risk.
Next on the list is foreign exchange, also known as Forex or FX, which pertains to the trading of one currency to another. Of course, if a company needs to buy something from abroad, they should have it in the currency from where they are buying it from. Hence, the need for Forex. And unlike shares, there is no central exchange used for Forex. Instead, currencies are traded in a vast network of banks, brokers, and dealers from all over the world through what is known as over-the-counter trading, 24 hours a day, 5 days a week, which makes it the largest and most liquid market in the world.
We know that all the ingredients of your breakfast, sometimes midnight snack tapsilog, all came from produces. The rice, the beef, and eggs, all of it came from harvests, livestock, and poultries respectively. These are called commodities, which are two main types, the soft and the hard. Our examples earlier are in the categories of commodities because it typically includes agricultural products and livestock. These are some examples. On the other hand, hard commodities typically include natural resources that are mined or extracted like these examples.
Last in our list is debts, which is an obligation to repay what you borrowed and normally with interest. Student loans, mortgages, credit cards, these are all forms of debts. But trade-wise, it is bonds which you can trade. So what is a bond? Bonds are investment securities where an investor lends money to a company or a government for a set period of time in exchange for regular interest payments. Entities issue bonds to fund profitable activities. The date stipulated on which the amount will be paid is called maturity date, while the interest of debtor pays within the period is called coupon. To summarize the lesson, we say that financial instruments can be classified through these three layers. First is that all financial instruments are contracts.
Second layer says that financial instruments can be of a cash or a derivative instrument.
And lastly, financial instruments can be classified through these four asset classes, namely equities, foreign exchange, commodities, and debts.
And that's it. This wraps up our lesson for today's episode. Please follow our channel if you want more contents like this. Again, I'm Rihanna Joy Cruz,
And I am John Kenneth Clemente.
and we'll see you in the next episodes. Bye!